Hello everyone. In this video we will be covering the topic of depreciation in financial accounting. To start with, what is depreciation? Depreciation is an accounting method used to allocate the cost of a tangible asset over its useful life. So it represents the reduction in the value of an asset which is occurring due to the use, time and obsolescence of the asset. Why depreciation is calculated? It is to reflect the loss of that asset value to show in the financial statement, because every asset which is put into use, it is not going to continue the same value. So over the time, as and when it is used, the value of the asset gets reduced when you want to sell it later. So to know that reduction in the value of the asset, depreciation is calculated. And it is also to ensure that assets are valued in a realistic manner. To know the exact asset value, match assets cost with the revenue they help generate. So to know what is the revenue they are generating over and above the cost that has been incurred or lost due to the usage of the asset. What causes depreciation? It is caused by physical wear and tear due to usage, passage of time, technological obsolescence and accidental damages. Now these are the reasons why depreciation has to be calculated for every asset that is being put into use in a business, and there are different methods to calculate this depreciation. We have various methods in calculating depreciation, but majorly we will be covering two topics, which is straight line method and written down value method in this video. So apart from these two methods, we also have annuity method, sinking fund method, insurance policy method, revaluation method, depletion or output method, machine hour rate method. First, we will see what straight line method is. So straight line method, it is a method where asset value is reduced in equal installments over its useful life until it reaches the scrap or sale value. So this method where the asset is depreciated, the fixed depreciation value from the first year till the date of its sale or scrap value, the depreciation value remains the same. So this method is preferred mostly for its simplicity and consistency. This is not going to have much complexity in calculating the depreciation value, because the depreciation value is going to remain the same throughout its useful life. And we will now see the merits of the straight line method. It is one of the easiest methods for computing depreciation. It results in a uniform depreciation expense every year. So it simplifies the profit comparison across the asset life. And then it helps estimate the asset disposal timing and the revenue value. Assets with financial planning and tax deduction consistency. And the last benefit is that it is best suited for assets that are used consistently over their lives. So these are the different benefits why depreciation under straight line method is most preferred by majority of the companies. Second method is the written down value method. The written down value method is also known as diminishing balance method or reducing installment method. It is one of the methods most commonly used technique for calculating depreciation. So apart from straight line method, which is mostly preferred because of its consistency and a fixed rate of depreciation over its useful life, written down value method is also commonly used technique by the business people for calculating the depreciation. So in this method, the depreciation is computed at a fixed percentage on the asset's book value at the beginning of each accounting period. Say for example, the first year the depreciation value will be calculated on the cost of the machine at which it is bought. That value will be reduced, and that at the end of that first year, whatever is the asset value, on that value the second year's depreciation will be calculated. So in this method, the depreciation value differs compared to the straight line method, where in that method the depreciation amount remains the same. Here the percentage remains the same, but the value of depreciation will change every year based on the asset value of the in the beginning of every year. Because depreciation is charged on the reduced balance each year, the depreciation expense decreases over year. So every year the depreciation value will be reduced it will be different, not fixed, and the value is going to be getting reduced because they are calculated on the depreciated asset value of every year. So now we'll move on to the problem. First one, we will see one problem under straight line method and also in a written down value method. So the question goes like this. On 1st January 2016, machinery was purchased for 30,000. On 1st July 2016, additions were made by purchasing another machine for 20,000. On 1st July 2018, the machine purchased on 1st January 2016, original value 30,000 was sold for 12,000. Depreciation is charged at 10% on the original cost method, which is our straight line method. A straight line method is also known as the original cost method. Now here there are two machines that are being involved. One is the first machine purchased for 30,000 on 1st January 2016. On 1st July 2016, same year, additions were made by purchasing another machine for 20,000. So 2017, there are no changes. The two machines are still being put into use, and on 1st July 2018, the machine which was purchased on January 2016, which is a first machine for 30,000, it was sold for 12,000. Now here there are two machines. First machine only is being sold, the second machine still continues to exist. So here goes the calculation for machine 1 separately and for the machine 2 separately. So the machine 1, it was purchased on January 1, 2016 for 30,000. So January 1, 30,000, on that depreciation 10%, 3,000 fully we will calculate. And in the year 2017, there are no changes, no sale, nothing. So the asset is in use. So the depreciation value will also be calculated for the entire year for the year 2017, which is 10% on the original value, which is 30,000. Again 3,000 for the year 2017. And for the year 2018, on this year, July 1st, the asset is being sold. It was sold for 12,000. So from January 1, 2018 to 30th June 2018, only for the 6 months the depreciation must be calculated. So on 30,000, 10% into 6 out of 12 months, which will be 1,500. So total depreciation will be first year 3,000, second year 3,000, and the third year 1,500, which is totally 7,500. And the asset value on the date of sale is rupees 22,500, and the asset was sold for rupees 12,000. So for an asset 22,500 value, it was only sold for 12,000, which means 10,500 is a loss for the loss on the sale of the asset. So for a value of 22,500, the asset is only sold for 12,000. So the company has incurred a loss of 10,500. Now coming to the calculation of machine 2, which was purchased on 1st July 2016, the same year where the first machine was purchased, but in the month of July. First year depreciation will be for 6 months. So from July 1, 2016 to 31st December 2016, on the original value, which is 20,000 into 10% into 6 out of 12 months. In the year 2017, there are no changes, no sale, nothing. So 20,000 into 10%, 2,000. And for the third year also, the asset is not sold, only the first asset was sold. So 20,000 into 10%, 2,000. And for the year 2018, the value is same. So here the asset value is being calculated for 2016, 17 and 18. So this is one sum based on the straight line method. Then we can see one more sum under written down value method, which is on July 1, 2010, Rajgopal purchased a second hand car for 18,000 and spent 2,000 on its repair. Whatever value is being spent, whatever expense is being spent on an asset for its purchase, that value should be added to the asset value. So here he has purchased a car for 18,000 and spent 2,000 for repair. So the asset value will now be valued at 20,000. This 2,000 will not be taken as an expense. It has to be added to the value of asset value of the machine, asset value of the car. So the value will be 20,000. On June 30, 2013, the car was disposed of for rupees 13,600. So here there are no additions. It is only one car. In the year 2010, July it was purchased, and in the year 2013, June 30th, the car was sold off for rupees 13,600. Depreciation is to be calculated at 10% per annum under diminishing balance method, and the books are closed on 31st December every year. So from the year 2010 July 1 till 30th June 2013, the depreciation has to be calculated. So from the date of its purchase till 31st December 2010, there are 6 months. So on the asset value, which is 20,000 into 10% into 6 out of 12 months, that will be the depreciation for the first year. In the year 2011, no changes. So after the 20,000 minus the 1,000 depreciation value, the asset value on 1st January 2011 will be 19,000. On the 19,000 only, 10% has to be calculated as the depreciation for the second year, which will be 1,900. So 19,000 minus 1,900 will be 17,100, which is the asset value which is taken over for the next year, that is for the year 2012. So for 2012, on the brought up value 17,100, 10% will be calculated because no changes. So full year depreciation 17,100 into 10%, 1,170. When we deduct that value from the asset value, the value is 15,390. So this 15,390 is the value we are carrying forward to the next year, which is 2013. On January 1, 2013, the asset value is 15,390. On this year only, June 30, this car was sold off. So only for 6 months the car was used in the year 2013. So from January to June 2013, 6 months only we have to calculate the depreciation, which is 15,390 into 10% into 6 out of 12 months. So the value will be 769.5. So when we deduct the value from the depreciation value from the asset value, the value will be, the book value on date of sale will be 14,620.5, which is the value of the car, and it was sold for 13,600. So from 14,620.5, it was only sold for 13,600. Obviously the business has incurred a loss of rupees 1,020.5. So this is how the depreciation is being calculated on written down value method and straight line method. So every business, whoever is making use of the assets for their business purpose or whatever purpose it is, once an asset is put into use or whether it is kept idle over a period of time, the value of the asset will automatically depreciate. And to know what is the value of the asset, if the business is planning to sell it off, the different methods of calculation of depreciation should be undertaken by the company. So that only we have learned 2 methods today, straight line method and written down value method.